introductions. Welcome, welcome one, welcome all to another Community Capital Live. Um, Community Capital Live, where we really get to talk to the people who are out there doing the important and challenging and creative work of, refunding and refinancing our economy for the better. And we're excited today to get to talk with Wilson with sorry I messed that up already. Wilson Lester. He will be joining us to talk about the fund that they have here in North Carolina, and it's not in front of me. I'm blanking on the name of it here. I apologize. Let me grab it.
Partners in Equity.
The Partners in Equity. I knew I had equity in there. Partners in Equity, to talk about the work that they're doing. And I'm really excited to get to dig into a fellow North Carolinian here about what they're doing in just outside of our backyard. But no matter where you are, thank you for joining us here today. Community Capital Live is a partnership of Impact Alpha, which is the place to go to learn all about impact investing. Neighborhood Economics, which is the gathering and the conferences that anyone here should be interested in going to, because you would really get to meet everybody that you would want to meet, and make those connections. The next one's coming up here real shortly, just in a week or so in Chicago. Is that right, Kevin?
It's on the opening party's the 29th and it's the 30th and the 1st. So it's right around the corner.
And can people still get tickets, or are you guys sold out?
No, we've got a space that is really big and flexible. It's kind of our first sort of high-tech, cool space. We've kind of done, church, not exactly a church basement, but this venue 610. It's got big time AV and some other stuff. It's kind of cool.
That's fantastic.
Yeah.
And where can people go to get signed up and register?
Neighborhoodeconomics.org. I'll put the actual link to the registration thing in the chat in just a second here as I do this.
Excellent. Appreciate it, Kevin. And Neighborhood Economics, definitely check that out and subscribe to their newsletter while you're at it, even if you can't make it to the conference. Also, the Main Street Journal, which is really the place to go to learn about local investing, which is why a lot of us are here, is to learn about local investing. I know a lot of you are here through the Main Street Journal. We love to welcome you guys. The Main Street Journal is the spot to go for that. And lastly, the Mindful Marketplace Show, which is the show I had on Biz Radio US, discussing social enterprise, community investing, and worker ownership businesses. So there's a backlog there of a lot of the episodes we had on Biz Radio US if you want to check those out at mindfulmarketplaceshow.com. I want to introduce our panel for today. We've got the aforementioned Kevin Jones, who we just heard from Neighborhood Economics. Kevin's also the co-founder of SoCap, Social Capital Investing Conference, Impact Hub, co-working spaces all across the country, and a few other things probably as well that I'm forgetting about. Kevin, really grateful to get to have you on here today to bring your insight. And also Michael Schuman, the man, the myth, the legend for local investing. It was his TED Talk 15 years ago or so that got me interested in this topic, and his book, Local Dollars, Local Cents, was my first dive into it. Michael's most recent book is called Put Your Money Where Your Life Is. So make sure to pick up a copy of that at your local bookstore, or ask them to order it for you, would be my suggestion. All right, let's go ahead and get into it here. So, yeah, Wilson, tell us a little bit about Partners in Equity. What was the impetus for starting things here, and kind of what's your background? How do you fit in here?
Yeah, great. Thank you for asking the question. Partners in Equity was founded by myself and two other gentlemen here in North Carolina, one being Napoleon Wallace, who at the time was the Deputy Secretary of Commerce, former investment officer for Kresge Foundation, and had worked in the C-suite and self-help in his career. The other was Talib Graves-Mans, who at the time was coming out of being the first Google Entrepreneur in Residence, the American Tobacco campus in Durham, and then the co-founder of the Entrepreneurship and Innovation Center at Shaw University and Knox Street Studios in Durham, North Carolina, which is a thriving entity supporting entrepreneurs across the state of North Carolina. and having also founded an event called Black Wall Street Homecoming that aggregated about 200 million in venture capital that came to the state of North Carolina searching for opportunities to invest in startups led by Black founders. At that same time, I was the CEO of a regional CDFI called Piedmont Business Capital. And we were all friends and just kind of were jamming on what would be the best way to fight displacement and redeveloping neighborhoods of the commercial corridors and helping business owners stay in those markets where they had been founded and grown and scaled their businesses and actually participate in the ownership aspect of the redevelopment that was coming into those markets. And that led us to creating a private equity fund that would help support low and modest wealth entrepreneurs with down payment support that may not have the friends and family in their network to lean on to put down that down payment on their building where they operate their business, or their business may be a little bit more cash strapped, cash intensified, and just can't pull the liquidity out of operations to create the wealth event of ownership for themselves. And that was the impetus and the genesis of us creating Partners in Equity to be that rich uncle for those business owners.
Yeah, and I'm excited to hear more about how the fund actually works, how it's more favorable to those entrepreneurs, the impact that it's had too. I did want to ask, you mentioned, yeah, uh, sorry, I had it there. You mentioned the allowing the business owners that were there to stay there. I'm wondering if you could expand on that because I moved to Asheville about 10, 11 years ago from the Detroit area. And Detroit was undergoing and still undergoing a massive, there's a lot of new local businesses going in. There's a lot of redevelopment, but there's also a lot of what you were talking about, where the people who had been there end up getting pushed out. In what ways are you seeing, or how are you guys thinking about attacking that issue, allowing the locals who have been there to really have that ownership as the, what's your kind of broader thinking on that?
Yeah, well, it still goes back to that early moment when we were, forming Partners in Equity as an entity and really going out and talking to folks about potential investment in our concept. I think May of 2019, Above the Fold, there was this article in the Charlotte Observer that was talking about the business owners in Uptown Charlotte that were being displaced. They had historically been tenants, various opportunities to reinvest in their communities were taking place. And then the large advent was Opportunity Zone and the tax bill from 2017 that was forcing a lot of capital into the market and markets across the country from outside of those commercial corridors that were convincing long-term property holders to transition their properties to new investors. And when you don't own, then you don't have you don't have an opportunity to participate or a say in what happens. So, when events like that occur, those business owners that are accustomed to paying rent uh, don't get to dictate their futures. And they also don't get to participate in the value that has been created by their tendency of stabilizing the properties that are in those markets. So, we felt that this was a prime opportunity to ensure that those business owners that are in redeveloping markets across the United States of America to have a shot at being able to own where they operate so that they can extract the value that's created by their tenancy so that they can transfer that asset to another generation that maybe isn't going to be the barber, that maybe isn't going to be the hardware shop owner, that maybe isn't going to be that Main Street business operator. And but they have a tangible asset that they can liquidate or utilize for what's their vision. Really quickly, I'll give you a snapshot story of a real place. It's at the corner of Boulevard and Memorial Drive in Atlanta, Georgia. there is a tire and rim shop that exists there. Prior to the current owner operator operating the tire and wheel shop there, his mother owned a used Cadillac car dealership there, and it was
Hmm.
known in the community as the Cadillac Corner. And when he was a senior in high school, she asked him, "What do you want to do?" And he said, I would like to own a tire and wheel shop. So she sent him to technical school so he could learn how to, change tires, learn that whole concept of managing vehicles and doing light maintenance. And she transitioned the asset to him so that he could grow and scale his business there. Every year they get offered upwards of $6 and $7 million for that site.
Hmm.
Uh, but they've owned it now for going on 40 years. When you own something in a market, it really gives you the leverage to dictate what your future is. So here's a guy that, wanted a modest lifestyle, decided that, he wanted to tire and wheel shop because he was into cars and that's what he wanted to do, inspired by the previous business that had existed there in his family. He now owns it. He has a couple of relatives that work for him and a few other folks creating jobs and staying there. And the day that he does decide to exit, he can either choose to transfer that asset to someone else or liquidate it for the wealth that is created through ownership. And we want everybody to have that opportunity. We want folks to be able to have a story like that, particularly when they've been existing in these communities for so long, to not have ownership and be controlled by, someone that's trying to, make the best out of their opportunity leaves them vulnerable.
Yeah, and what do you think is the key piece for y'all to to get to that ownership place, to get to that place where that ownership is local that way?
Capital. I mean, there, we talk about it so much in these circles, but there are various applications for capital, whether it be inside your business, whether it be scaling your business, whether it be stabilizing your business. There are so many uses for it, and our specific application is for acquisition of commercial assets. And the way that we see it is that if a business owner has been operating uh, in their garage and now they're scaling into, the warehouse is moving from the garage to, a 5,000 square foot facility because now they're doing fulfillment at a much higher volume and need the right positioning to be able to get their product and package to uh, the types of delivery systems that are going to maximize the scalability of their business. We want them to be able to have everything that they need to be able to do that, and that includes cash on hand. So even if that business is generating income, think about them having that excess $200,000, but the property cost $1 million, and their traditional loan is going to require them to put all the $200,000 they have into that deal. Or a long-standing business that has saved $200,000 and now they have to put their life savings into that transaction. Entrepreneurship in the United States of America is the fastest pathway to wealth creation, bar none. It's a fact. But folks that experience that and become those entrepreneurs also are generally the most wealthy people in their immediate families. And that creates a whole other externality and dependency on the liquidity that they have as well. So
Mhm.
we want to make sure that those entrepreneurs have an entity or somebody that they can approach and discuss whether or not uh, this is the right time and that we're the right partner to help them scale into ownership and creating the wealth event that they can pass on that tangible asset without having to completely liquidate their next egg, but I have to pull all capital out of operations to make it a reality.
Yeah, that sounds huge for those families to not have to do that. Um, I want to turn it over to Michael and Kevin here to go into some more detailed questions about the fund, but I did have one more question for you, Wilson. Is that Nipsey Hussle behind you?
That is Nipsey Hussle behind me.
Okay, all right, I thought so. I just wanted to make sure. All right. Michael, go ahead.
Great. So, couple of questions just to sort of give us a way of visualizing what you've created. What year did you create it, and how big is the Partners in Equity now?
Yeah, great. So we created the fund in 2019, late 2018, maybe. We were not capitalized until February of 2020, which was prime time to be capitalized with a private equity fund focused on acquiring commercial real estate for people to do business. But despite all of those environmental challenges, we were successful in proving our thesis through a catalytic investment from a single family office that allowed us to, in a petri dish, test this idea on whether or not we could create multi-generational wealth through asset acquisition. And we were successful in doing that, investing in 3 sites across the state of North Carolina uh, that have just flourished for those business owners that participated, and allowed us the track record to scale to a fund, our second fund. So right now, we're just shy of $10 million in AUM, and we've had our first close. So we're continuing to close. Our first close is in June. We'll finish closing out this fund June 2026. So we're continuing to do that work, but we are actively investing in transactions across our footprint, which is specifically if you draw a diagonal line from DC to Dallas and Chicagoland and the Los Angeles area. Uh, we've had the opportunity to see a number of exciting opportunities so far, and have already approved 3 investments.
And are there specific sectors that you're looking at? And curious how you actually discover and evaluate and then make the decision to go with your investments.
Uh, there, we are industry agnostic for the most part. We do not invest in businesses that we think are retail businesses that we think are going to be harmful or non-beneficial to the community. We're probably not investing and not probably not, we're not investing in vape shops, smoke shops, things that you see consistently pop up in communities that don't uh, scale the quality of life for local residents and the business community. So, we're going to shy away from those things. But everything else pretty much makes sense, whether it's retail, doctor's office, light manufacturing, all these things make sense for what we're trying to accomplish and for what our target business partners are trying to accomplish. The way that we
And
come across the lion's share of our transactions are through our business network. Okay. So interactions that we have like this usually result in a tremendous number of leads, relationships with people like Kevin and folks like that around the country tell us about businesses all the time that are in search of the right kind of capital. But we have been very fortunate to create MOUs with CDFIs and CDCs and banks across the country that are able to present us with transactions that could be accomplished but for equity. So it puts us in a real great position to see quite a number of opportunities and select which ones will be the best for our capital and create the best outcomes for the entrepreneur.
I've seen with various residential investment companies how they sometimes structure the deal where you can buy shares of a down payment, and then when the house gets sold many years later, depending on how the appreciation goes, you'll get a bump up or a bump down in some percentage of the sale. Is that kind of how this works here?
Uh, are you saying where a collective invests in the down payment?
Well, I guess I'm trying to understand. So you said at the outset that your strategy is investing in the down payment, putting equity on the line.
Yeah,
How does that ultimately get paid back to you? What's your exit on it?
thank you. Appreciate that. Uh, so essentially, we buy equity in the property is what we're doing. You know, with that down payment, it buys us a percentage of the equity in the property. So if we, let's just say for rough numbers, and these are not exact, but let's say property's $100,000, we put in 100,000, that buys us 10% of the value of the property. The property escalates in value over 10 years, 5% a year. So 10 years is generally the horizon for refinance. That property is now worth 1.5 million. Our $100,000 worth of equity is now worth 150,000. And the business owner would then refinance us out, buying out our position, and they would be in the deal alone, having enough equity to refinance the transaction without needing a partner. So think about that. So let's bump that number up to our original investment being 150. We require the business owner to come to the table with 5% at least. So to make that traditional 80-20 loan that the bank is going to do, 800,000 on that $1 million property, we come in with 150, the business owner comes in with 50,000. The multiple on investment for the business owner is much stronger than the multiple on investment for our 150,000. So the property scales at the same value, is worth 1.5 million in 10 years, which then takes our equity up very minimally. But that $50,000 that the business owner injected is seeing a 7-time multiple at least. So,
Right.
we want to put the entrepreneur in a position of power and an ability to be self sufficient without needing a partner.
Right. And it seems like because you're investing in existing businesses with longstanding ties in a community, uh, there's a much lower risk of that business failing. It's already proven itself, and that's probably helpful for making the whole thing work.
Yes, we do not invest in startups. We invest in businesses that have existed for a minimum of 3 years and can demonstrate that they, year over year, are scaling what it is they're doing. I'd say the average life of a business that we're looking at is probably about 7 or 8 years old at least. And that's just what it's turning out to be. That's not a goal. That's not a sweet spot for us. It's just as we begin to come across business owners and talk to folks about what they're trying to do, that tends to be about the average age of the businesses. But every once in a while, we come across a business that's, got longevity. Right now, we're talking to a second generation business owner. Business has been in business since 1991, and they're trying to create that opportunity to scale into property ownership.
Let me squeeze just one more question in here before I pass it on to Kevin, and that is private equity, almost by definition, is a small number of deep pocket investors who are putting money into this project. Have you thought about ways of shoehorning in, more grassroots investment that wants to participate alongside in your projects and what that might look like?
Yeah, that's a great question. So one thing that we do not like to do, Michael, is Kevin will probably attest, back me up when I say, he probably wishes we were a little bit louder about what we do, but we're very intentional about doing the work and not talking about the capital. But one of the things that we're working on doing is after we've accomplished a decent number of deals in this fund, what we plan to do is offer, and this may not be in this fund, it could be in a future fund, but all of us need to be thinking like what you just described. And what makes sense is to find cohorts of people that are mission aligned with funds like ours or funds that are trying to create impact and create smaller entities that can pool the capital and invest as a collective. Why that's important is because private equity funds tend to work with a smaller group of people, it's more manageable to report to one company versus reporting to 100 different individual people. And we want those people to receive one report. You want those people to receive one report in a very managed way and in a scalable way for folks that are doing work similar to us and for our type of work.
Yeah, I think that makes sense. And look, we've interviewed, I think at this point, it's close to 3 dozen different funds around the country. Many of them are tiny, with great grassroots intentions, and they need a buddy like you to get their work done. So it's kind of an intriguing prospect of marrying these things together. Kevin, over to you.
Yeah, thank you, Michael. Yeah, I've been a fan of Partners in Equity since, it kind of started. And I'm one of the things that's interesting is that it fills a gap for folks who don't have collateral and don't have friends and family funding. And, CDFIs are wonderful things that just the money doesn't reach the ground, and if you have collateral and you can handle 8.5% to 9% debt service, they're great. And many folks are not in that category. So that's, it accomplishes a bridge that eliminates a structural injustice. And I think that's pretty interesting in the way that it does. It's just a really smart aspect of capital. Now, we have our conference, and Wilson will be speaking along with Napoleon, zooming in next week. And I'm talking to one of the we got a bunch of big foundations sponsoring us, which is a great thing new for us at our conference on the 29th, 30th, and 1st in Chicago. Kellogg and MacArthur and one of the Walton family folks. And, they said they were able to now look at Partners in Equity because they were, by their bylaws, prohibited from investing in a fund that was targeted at Black-owned businesses, which you were when the words were different, and we could use different words. We've done a fund with Eagle Market Street, Stephanie Swepson Twitty, and it was targeted at BIPOC folks and women, and now we have to do all the community can thrive. And I wonder if you've seen that being an opening for you, or having to change the narrative or criteria is a hindrance, Wilson.
I think that what's important is that people have opportunity, and our goal is to provide that. We in our first fund, we had a mandate from the capital owner to focus on the African American population in North Carolina. And we were successful in that. In this fund, there's no racial mandate. There's no, and as a company, we don't have a racial mandate. I do think that language is extremely important, because uh, bias, just because you're a do-gooder doesn't mean that you don't have bias. And just
I know that's right.
just because you feel justified in what it is that you're doing doesn't necessarily mean that it is not also discriminatory. Uh, what we want to offer that we think is the common thread is an opportunity for wealth and generational wealth. And there's a lot of people from different neighborhoods having the same life experience. And what we want to accomplish is uh, providing those people that are having that experience or that represent communities that have not historically had access to capital within their families and within their markets, have a shot at the same dreams, the same opportunities that people that do come from wealth and do have more access to capital experience. What we also realize is in some sectors of business, people just don't, where folks haven't historically been, uh, there's a lack of opportunity. That while this is not a real estate business, uh, one thing that you don't see a lot of people from low wealth communities doing in the contracting space is earthwork.
Hmm.
I mean, do you know how much one of those tires that's 10 feet tall costs? To be a person that purchases that kind of equipment, you have to have access to some things that are not general. And there's so many people that escape that. And we believe the Partners in Equity is positioned now to help be a solvent for folks that are in that position.
Yeah, that makes total sense. And Steph and I were talking about it yesterday, and she just said, "Well, we raised some money around the death of George Floyd that was just." I thought, "Hey, this is going to be a wave," and Steph said, "No, it's probably just a moment." It, turned out to be a moment. But the structural inequity, we also are using just in our stuff. And we invest in folks in neighborhoods where people die 10 years younger, which are, or where the neighborhoods, the poor neighborhoods that are subsidizing the property taxes of the wealthy neighborhood. I mean, you can, the issue is wealth creation. So I think that's really interesting. Yeah. Do you see a product line expansion from the building that they want that they don't have collateral for, and you unlock the CDFI money, which is so much of the creativity in finance is unlocking CDFI money that doesn't quite reach the streets, but it's wonderful if you can imagine a way to get it. But do you see, would you go to, construction equipment or other CapEx, those sorts of things?
No.
Okay.
And here's why. We have decided with the residual of our careers that we're going to focus on this thing. And that there are a number of different solutions for other things. And we encourage people that are interested in this space where they see gaps in those other areas to bring new ideas to the table to help solve for it. And there are a few folks that are, and there are a few products in the marketplace that address equipment. But what we want to make down payment assistance for a commercial acquisition to be as easy as flipping on and off your light switch in your house. And what that's going to take is it's going to take us continuously doing this, scaling this, and getting better at it, creating more capital stacks for it until there is at some point enough folks in the marketplace that have identified this is an investment asset class that is highly accessible. One of the things that this group may not be aware of as we talk about this, but in the world of private equity and commercial real estate, Main Street business, local business, small business is not a part of that conversation.
Right.
Commercial real estate and private equity is skyscrapers in New York City and Los Angeles and Miami that folks have dumped $100 million into for office space and for different types of property like that. That is the commercial real estate investment class. This Main Street corridors, these businesses that exist in your small town that aren't, 10 stories tall, that's not really part of the investment group and package that large capital is generally thinking about. But it is a big chunk of it's billions of dollars in assets in this space. And what we're trying to do is demonstrate to capital that not only is there an opportunity to create a wealth event for the target business partner, and while that $150,000 investment isn't going to see a 7x multiple, the return on it is competitive with every other investment class out there and is backed by a tangible asset. And that's what we're doing.
Right. So you have to validate the category and then get the bigger money to say, oh, in the aggregate, this is a big thing. Do you see possibly bundling some of your things for resale once that's validated?
Repeat that, Kevin.
If you had several of these investments, could you see it, a secondary market in some of your equity before the 10 years, once people see it as a real asset class and then you validated the category?
Of course, there's potential for that. Whether or not that's something that we'll look at is not yet a part of our strategy.
Yeah. Yeah. Where would you imagine and hope to be in 5 years?
5 years, I'd hope that we would be at 200 million AUM plus. Hundreds of properties across the country invested in, and hundreds of properties, if we can get to, 500 properties across the country, that is at least, that's at least somewhere between 450 to, I would go ahead and say that's probably $500 million families.
Right.
To be real, every investment that we've closed, including the ones in Fund 2, the business owner has at minimum been $250,000 to the positive at the time that they signed the paperwork at the attorney's office. And if they're that at day one, 10 years from now, they should be significantly beyond that. And if they continue to hold the asset beyond our participation in it, they could quite likely be holding on to $1 million asset, certainly as they pay the principal and interest. And as the property continues to appreciate, that's what they're looking at. And that's what we're talking about, where we want to put families in that position.
And do you see any potential aggregation of the wealth of those folks who have $500,000 to $1 million that could be co-investors alongside for the next generation? Do you see any way to make the folks who paid you off come in as limited in some way with partners in equity?
I certainly see that. And if not investing in us, reinvesting in ourselves, in themselves, and further demonstrating the value of this. One of the most successful stories from Fund 1, we made an investment December of 2021. The business owner we made the investment with was skeptical about whether or not they would be able to owned commercial real estate and how it all worked and how private equity worked. And once they did the deal, they now own 5 properties within a mile and a half of each other in Durham, North Carolina, in downtown Durham, North Carolina, which is one of the hottest real estate markets in the state. You know, they were able to leverage that first position to continue to scale their portfolio. And I think the message is that we can do this, that you can do
Right.
this as a business owner. And we want business owners to see that and to internalize it and carry it forward.
Right. Let them believe and look around and believe. Yeah. And Joe, I think there's some really good questions I've seen in the chat if you want to take it over. Thanks, Wilson.
Not a problem. And I apologize for the if you hear any background noise, that's one of the benefits of owning your own building on Main Street is you get to participate in whatever is happening in your city.
You could be right in the middle of everything. Let's see. Yeah, we had 2 questions come up. If anyone else has any other questions, go ahead and either just, say so in the chat or put your question in the chat so I can call on you here. So David, I think, had a more general question. This might just be kind of for the whole panel here, about the likelihood of continual federal support for the CDFI movement. Anyone got a feel on that right now?
My brief opinion on it is what is the outcome of CRA? The banks have utilized CDFIs as a way to accomplish their CRA requirement goals. If that goes away, I don't see the banks having a need to continue to support CDFIs. However, I do think that there are a number of CDFIs with enough liquidity that they can continue to operate as lenders. But, it's going to look and feel very much like the bank. It already does. And, that will, effectuate some consolidation. But, I'm as a CDFI alumni, I am hopeful.
I like that. Yeah, I don't know if Kevin, if you had anything else to add on there, but
No, I think, CRA is Community Reinvestment Act, for those who don't know, and it means that banks who don't invest in those neighborhoods give it to CDFIs. And so if there is not that requirement, and there does not seem to be much of a push for economic justice in the current federal administration, I think you have to figure it's one of the things that will be at risk. And so, CDFIs are already too much like banks. They probably will become more like banks. And so that again means, structures like partners in equity that unlock the money that is there in CDFIs are going to be more valuable. CDFIs are like banks just 2 steps up the hill beyond where you can get to on a normal basis. And so you have to build these bridges up to where the CDFIs are. Right. And they'll have less money.
Yeah. Thomas, I wonder if you can go ahead and unmute here. I'd love to hear you get to ask your question.
Sure. Hang on just a minute.
Yeah, no problem.
Yeah, first of all, it sounds to me that the model that you're using is shared equity in a mortgage. Is that correct?
The business owner holds the mortgage and is the guarantor for the mortgage. But yes, I guess you can try to distill it and simplify it to that if that works for.
How much bank involvement is there?
Bank is 100% involved in most cases.
Okay, so the bank holds the mortgage,
Yeah,
and you contribute a portion of the down payment,
correct.
and the business owner contributes another portion of the down payment.
Correct.
All right, so you are all participating in a mortgage. So your model
But we
requires
do
that.
not guarantee, just so I make sure you're clear, we do not guarantee the mortgage, and we are not underwritten for the mortgage. That is solely on the target business partner.
But if the property ends up declining in value, I know in today's market that seems unthinkable, but you know, these things do happen. If the property declines in value, um, your equity share also declines in value.
Correct.
Okay, so if the property is sold, you've experienced a loss along with the business owner, correct?
Yeah.
Okay. All right, so I would characterize it as a shared equity in a mortgage. That is what your investment is. Now, it's been said that you don't own a property until you own it free and clear. That means without being encumbered by debt. So, in the example you gave of the five businesses that this, or the five properties that this business was able to acquire, uh, are those heavily mortgaged? I would assume they were.
I'm trying to understand your point. I'm sorry.
Okay, you started with one property owned by this business.
Yeah, well, let me say it this way. Uh, are you a homeowner?
No, I'm not, but I was.
But you were. Did you get to a place where you own the home free and clear?
No.
Okay. So most folks, at some point they may get to that place, which is a great position to be in. But most people that are buying property get a mortgage. That's the way it works. They're not a lot of people that are walking out here with checkbooks where they could just strike a check and buy a property free and clear. So you may not own it outright, but because you're liable for it, you do own whatever value exists in that property. So if there's any positive value beyond the value of the debt, then if you're in good standing, you do own that equity. So, you know, it as long as you're in a position to cash flow the debt service successfully, then, in most cases, a lender and certainly Partners in Equity is underwriting you too. We're not going to place capital if there is a question of long-term solvency.
Okay,
And
but this is a cautionary point. You know, during the mortgage crisis of 2007, 2008, we saw a lot of these mortgages were given to people that weren't able to service them. And the property
this
values,
is completely different. This is a completely different era. They completely changed. Underwriting changed through that advent. That market, I remember, and you know, I remember moving to Atlanta in 2023, getting a new job, and really didn't was just starting out and being offered a mortgage to buy a 200 and some $1,000 townhouse within a couple of months. And I got scared. I was like, I didn't know why they were doing that, and I chose not to take it. But I have friends that did, because at that point in time, the market was predatory, and the market was allowing for some things to happen outside of the box of credit. But the credit box has tightened so much that uh, you really have to demonstrate solvency to acquire a mortgage. Now, is there an event that could cause the value of property to slip significantly, absolutely that can happen. But that is a risk that we all try our best to hedge against. Our hedge as a fund is a preferred rate of return, a minimal preferred rate of return that that we defer. One thing that I didn't mention is we defer our return to the horizon of the investment. And let's say that there was a slippage in value, that preferred rate of return is designed to keep us as whole as possible. But if it's not there in the equity of the property, it's not there. And
Okay,
and as a rich uncle fund, we're designed to be that friends and family that's in the deal with you in the event that it doesn't go the way that we all think that it will go.
okay, Wilson, thank you. Thank you for answering the question. My other question had to do with your sources of funds.
Okay.
What are the proportionate shares of the different sources of funds?
Like what percentage of my fund is funded by different organizations?
Yeah, well, types of organizations or grants or government or nonprofit organizations.
We have no government capital in our fund. Our fund is solely made up of ultra high net worth individuals and large national foundations. Kevin mentioned that the MacArthur Foundation is a sponsor for the Neighborhood Economics Conference in Chicago. They are also currently our anchor funder in this fund. So
Okay.
we've worked with private organizations that are aligned with trying to create wealth in community, and individuals that have amassed a significant amount of wealth in their professional work and are committed
Okay.
to creating an opportunity for more people.
All right. Thank you. I think I better understand what you're doing now. Thank you.
Thank you so much for being on the call and asking your questions.
Sure.
Excellent. We are coming up on time, but Wilson, I wanted to let you kind of close out here by, when you're looking forward here at the next steps of the project. I know we look kind of on the bigger scale earlier, but I am curious, as you guys are moving forward, you guys are, it's this neat combination. I think, we hear private equity, and like you said, most people's minds go to something completely different. How do you guys balance? What's your kind of guiding principle in balancing the needs of the capital returns and then the impact that you are trying to make? And where can people find you to learn more about the work that you all are doing?
So I just dropped in the chat early on my email address and our website. So feel free to shoot me an email, reach out there at the website to learn more. Happy to schedule time to talk offline about what it is that we're doing. The thing that I would like to leave this group with is that we founded this company because this wasn't a post George Floyd activity. This wasn't some event is happening. This is a group of people that were working with entrepreneurs, were lending money as loan officers or leaders of institutions, deploying capital, and could see the writing on the wall that the only thing that was going to help people was benevolent capital in a creative way. And what we decided was that we were going to try to be that force that could help make banks capitulate is Kevin used the word help unlock money from institutions that, wouldn't lend to, I'll pick on my new friend, Thomas Greco. Okay. Thomas owns that business. And sometimes when they do these loans, they want Thomas to have some money after the deal. They want to be able to see that he's going to have $25,000, $30,000 in the checking account after the deal. Well, if Thomas has to put the down payment down and he wipes out that 20, 30 grand, he doesn't have it. So he never gets to own the building. He never gets to pay the rent to himself. If he ends up having to sell the building in the future, if he's rented it all that time and he's created the value by keeping that property stabilized all that time, he's created hundreds of thousands of dollars for the property owner, and he's created hundreds of thousands of dollars in taxes paid, and he's created net value in the property because he's maintained it. He got it pressure washed. He was responsible for all these different things to keep it up. And now he's just out. But instead, when he retires, he can sell the property and he has $350,000. He can move to Wilmington. Okay, and be a beach bum if that's what he wants to do. But we want to give people the option of having that choice, and it can happen in a way where our fund can make a return for our investors. All of our investors are impact investors, so they're just looking for their investment to go up so they can put it back to work in a different way in some other area in the community. But yeah, that's what we're doing here, and I appreciate all of you being on the call and being in the gym on this type of information and wanting to be in front of it. And I hope it's useful to you. And if it's not useful to you, that you share it with somebody that you think it may be useful for.
Yes, absolutely. Please do that. Make sure that, I think it was Nicole from Equal Exchange who said that this call is the best kept secret on the internet. Let's all change that a little bit. Let's tell someone about this one, share what Wilson's doing. They're in the Greensboro and beyond area. Really good to meet you and really good to get connected. Thanks to our panel, Michael Schumann, Kevin Jones. Thank you to all of you who joined us. Thank you for spending your time here with us. And Jen, we've got a couple weeks until the next one. What's our next and upcoming Community Capital Live?
Yeah, on October 8th, we are going to have Alex St. John from Just Futures join us at 2:00, and I'll be sure to send out the link in the follow-up email that I send you all tomorrow morning.
Wonderful. Make sure to go to Main Street Journal to get the recording of this to send around or to watch later. And yeah, until next time, remember, we are each other. Take care, everybody.
Thank you so much.